Dinshaw Irani joins us now. Dinshaw, good morning. Thank you for joining us. When you see a news like this on a bank, which is relatively got limited history, it just makes you wonder that is more coming. Is more coming for the financial sector. Markets were in a sense getting convinced that the worst is behind. Banks had taken all their provisionings post-COVID, but now, like they say in English, skeletons are coming out of the cupboard.
Morning, Nikunj, and a very good morning to your viewers and season's greetings to you, your team, and the viewers as well. Nikunj, so I don't know. I mean, if you hear the conference call of the bank, in fact, I heard the management on your channel also this morning. They're quite convincing in the fact that there was nothing wrong with their balance sheets, and the RBI hasn't found anything wrong, but still they're taking precautionary measures, but not convincing though. But still, I mean, I would say that I think RBI is on the cautious side and doing whatever it feels is the right thing to do. Though their report hasn't come out for FY21, I'm sure when that comes out, that will assuage a lot of frayed nerves as such. So I think this was one-off, and probably RBI is a smaller bank. Maybe there are problems with smaller banks happening, but I don't think you can drag it across the sector and say that this is what may happen as such. In fact, so I don't think this is you can stress this across and take this as an example for the whole sector. I think it's a knee-jerk reaction in the market. Things will stabilize. I think the banking sector is the one to look forward to.
Would you be a buyer in this fall in franchises like RBL or other banks which have a large exposure to unsecured loan? Because that's what markets are worried about. Unsecured loans which were given pre-pandemic, during pandemic, they could bite them back. Is the fear slightly overdone? I'm asking you a slightly technical question just for the benefit of our viewers, but I'm sure you have understanding there.
Nikunj, so I thoroughly agree with you. I think that is one area where you have to be cautious about. I mean, in fact, we as a house, we always been bullish on large private sector banks. We've never gone to smaller private. We did participate to an extent till the time we realized that this was the growth was being unbridled, and there was a lot of risk being taken for growth. And that's when we started moving out of the private sector banks as such. Some of them you mentioned earlier on the Sonia show. So we moved out of them at a good price. And frankly, I mean, they've gone nowhere. So our recommendation is stay away from smaller banks who have these unsecured books up to their necks as such, and stay with the larger banks where I think there's still consistency of growth coming in, and that is what you're looking at in the future, consistency of growth, and that should help the banks also be great. So stick with those.
Where are you buyer in this fall? We've spoken about banks, but apart from banks, where else are you buyer?
We've been very clear about our stance in the market. We've been buyers in IT space. We've always liked it from very beginning, and we're still sticking on to it. I think there's another 3-4 years of growth to go here. We talked about re-ratings earlier. I think there's still more re-rating happening, as and when the consistency kicks in. As such, Accenture was an eye-opener. The way they upgraded their estimates for the coming year, that was a total booster for the sector, I believe. The second one is pharma, which is again a safe haven. You won't see any fireworks here. In fact, the whole of 22 is what we're looking at as being a year where it's going to be a stock pickers market. It's not going to be a phenomenal year for the way 21 was. So we are looking at being very cautious in the market, stick with the names where we see consistency and where there's a clear path of growth ahead as such. So these are the sectors we're looking at. There are certain opening trades that one can play, but that has got delayed because of Omicron led wave again. But still, I think these are the few sectors that one has to be in and be safe.
Right. Dinshaw, the last time we were chatting, you very famously coined the terminology that buy now, pay later might turn out to be buy now, pay later. Do you continue to be circumspect of the financial services at large, not just banks? And in that light, maybe the other way of approaching it could be that given this kind of fall that you are currently seeing in the entire financial pack, maybe one could nibble in at the bottom, or would you say completely avoid this space?
Aisha, the whole reason was this only, that when you're talking about unsecured lenders, these guys are the masters of that. I mean, the new age fintech guys. So I don't know how they will get insulated when the banks, who have their branches in place and everything in place, and they're coming up with their own techs and stuff like that, they're getting affected. I mean, RBL, I'm sure, was a case in point. So that's why we were very clear that it's going to be buy now, pay later for BNPL as such. That's the new terminology that we coined in our office per se. So it's better to avoid. You may miss out a few good names, but the point is that you'll at least stop palpitations from happening in your heart. If you being safe, it's better in these kind of choppy, volatile markets. I would rather stay away.
You know, something very interesting is happening within real estate, and I was just chatting with our earlier speaker as well, Dinshaw, about it. While real estate revival, of course, is playing out at large, some large projects, I mean, something like a Lavasa, for instance, which was not getting any bidder for years to come. You know, people had forgotten about Lavasa altogether. It finally got sold for about 1,800 odd crore rupees. Do you sense that this realty revival is part of a very big investment theme and perhaps a multi-year run and not just a very short-term, investment bet?
Actually, if you see the price, I mean, it's all a matter of realization, right? I mean, if you see the property prices, they've not moved a bit for a very long time. In fact, if anything, they've been correcting all the while. And it's now that the prices have stabilized. So you'll see a lot of buyers coming in, pent-up demand coming up. I mean, the sector has been agog with excess supply in the market, which is getting absorbed now. So obviously, when such things happen, it's you're looking at a longer term move in the sector. We are more comfortable with the residential part of the business rather than the retail and the commercial part. Commercial is still acceptable. Retail, I think, will be a while before it picks up, given the kind of new variants which are coming up per se. So that's why it's avoidable. So the ones which are residential heavy in metro and tier 1, 2 towns, I think those are the ones which you should be looking at for real estate plays. And most of the listed players are fortunately in that space per se. And that's why we're quite gung-ho on that space.
It now becomes more like a buy than a hold. But the question is, do you go back to the classics, TCL, TCS, Infosys, Wipro, big, large, and they are cheaper than their mid-cap counterparts like L&T, Infotech, or LTTS or Mindtree?
Nikul, one thing that our hedge fund has taught us, and we've been running that for the last 16 years, is you have to conserve on the downside. And these are the best plays when you're looking at conserving on the downside. You need to reduce the beta of your portfolio on the way down, so that on the way up, whenever the move up happens, you're in place to move away from these large caps and get into certain high beta names and then move that. So I think that is the way to go about, because our feel is that probably the first half of 22 itself, it will maybe a range bound kind of a market. There may not be too many up moves, given that the valuations are at real high levels in certain sectors, so you can't justify them also. So that's why it's better to be in safety than in aggression. And that's why we're doing that. In fact, we are always very conservative with our investors' money, and that's why we tend to play it this way. So be in the large caps, be in safe space, pick out certain stocks which you think are good in the mid and small cap space, which we have in the portfolio. It's not that we don't have any mid caps and small caps. We do have. We're nibbling at it to an extent, smaller extent. But I think still there's a way to go before they also come and participate in moving up.
Dinshaw, do you think in 2022, since you run a hedge fund, there is a 50% chance of making money by going short also, as in the probability of making money by going short is also high?
It's always a time period in which you make money on the shorts. Invariably, in Indian markets, if you see the history, 1/3 of the time the markets are in a fall, and 2/3 of the time they're in a rise. So invariably, we end up losing money if you're short all throughout per se. So you want to be conservative. you need your shorts in place because it's a hedge fund, right? So you need to have the shorts. What you play around is with the net. So you can shift your net from 50 to 70 when you think the markets are moving up, and play with that and try to increase the beat of your portfolio, as I told you. So that is what you try to do. There's always be volatility in the market, and that's what makes the markets interesting, right? If it was a one-way move in the market, it wouldn't have been that interesting at all. So that's what you try to do with such. Yeah. So today we are more cautious, and that's why our net is reducing to an extent.
You're market cap agnostic, right? I mean, is there a case where perhaps in 2022 mid and small caps could do better or underperform the large caps, or not quite?
I mean, look at the valuations of mid and small caps. They're way beyond that of the large caps. Okay, there's no arguing there. In fact, the recent fall was led by the mid and small caps. So it's obvious that there is some semblance of normalization which is coming into play. Invariably, the mid caps and small caps are at a slight discount to large caps. In fact, whenever there's a huge flow of IPO money, I mean, IPOs in the market, the mid and small caps are the ones which tend to suffer because portfolios move away from these names, liquidate those names, and get into the other mid and small caps, which are getting new listings are happening. So it's obvious. And in fact, next year, again, it's going to be a huge flow of IPOs coming into the market. So I think that that segment will suffer for a while. I mean, as in not suffer, but at least you'll be cautious in that segment and be very selective in your picks. You can't just go and buy sectors out there the way you can do in large caps.
Yeah, absolutely. But what about those, trends which have worked very well? In fact, even pre-pandemic, some of them, your specialty chemicals, the entire ethanol story, your Praj, your sugar names. Do those investments still hold for good?
Aisha, we are very conservative on the valuation front always. I mean, look at the kind of valuations those guys have hit, and the growth that they are looking at in the future. The growth has become more linear now. I mean, as in the sense it's become much more normalized now, but the valuations are still so stretched. So we would be more cautious in that space. We'll be very, probably a name or two there and there, but otherwise, don't think we'll be that the kind of returns that one saw in 21. I don't think that's going to repeat in that sector per se. That's for certain.
So Dinshaw, what is that out of box idea for 2022 and beyond? You would say, look, इस idea का समय आ गया है.
So idea का समय आ गया मतलब
what is that out of the box idea? For example, if you say I'm buying IT, it's in the price. It's more like a hedge. If you're buying if you're buying banks right now, you're buying them as a different idea. So what is the new idea or a theme which you've identified?
What we feel is that certain sectors which have suffered quite a bit because of the pandemic, I think those are the ones to keep your eyes out on. Hotels being one such sector. They've been propped up by domestic tourism, but domestic tourism doesn't bring out the realizations. I think that one sector where if things turn around and if international tourism starts, I think that's one sector that could open up quite a bit of move as such. I mean, we should see quite a bit of move as such, given that the ARRs and stuff like that are very low in that sector per se. So I think that's one sector that could one look at. Otherwise, I don't think this is a time to discover new names. I think you have to be very careful in your estimation of your stocks and be conservative rather than try and get into newer names and newer ideas and such. So, at least for the first half, that's what I feel. Probably the budget will lay down certain trends, and maybe that is what you may have to look at later, given the fact that the government of India has enough firepower to manage the capexes. I mean, look at the flows from their taxes per se all across. They've been way beyond what their estimates were. So I think that should be one that one should look out for, which in a way is normally a budget is a non-event, but I think this time around, given that there are very limited positive triggers, I think the budget could be one which should prop up a few ideas.
Well, Dinshaw, wonderful to have you, and I wish you a wonderful year ahead. And thank you for being part of ET programming, and thank you for always generously accommodating our interview requests.
And all the best to you all also. Thank you.